Good afternoon, everyone, and welcome to our webinar today. It's on From Tariff Ripples to Economic Waves. My name is Stephen Millard. I'm the Interim Director here at the National Institute of Economic and Social Research. I'll be chairing today's session. We have three excellent speakers. Paul Mortimer-Lee, who's a NISA Fellow, is going to tell us about the impact of the tariffs on the US economy, and indeed what is going on with the US economy that has kind of led to the imposition of tariffs in the first place. Fergus Jimenez England is then going to talk about the macroeconomic implications. This is on the global and UK economies of the tariffs. And then finally, Adrian Pabst is going to talk about the impacts on certain regions of the United Kingdom. Each person will speak for around about 10 minutes. That will give us lots of time for questions. If you could put your questions into the chat as we go through the presentations, then what I will do is I will call on you to ask your question and we'll unmute you and enable you to do that in the Q&A session. So please, please, please put lots of questions down into the chat so we have plenty of discussion after the people have presented. I don't really have anything else to say for now, so I'm going to hand straight over to Paul Mortimer-Lee, who's going to answer the question, what are financial markets telling us about tariff effects? Over to you, Paul.
Sorry. Yeah, thank you for joining and thanks for inviting me, Stephen. I think the markets got very worried by the tariffs to start with, and there was clearly quite a lot of stress in financial markets in the US, and we saw that in numerous ways. So this is a financial stress index. You can see that there was a huge spike, which was bigger than we saw in early 2023 when there was a dash for cash. And most of that was due to volatility in stock markets and volatility as measured in the movements of various asset prices. That has gone away. And so the markets don't seem too worried about what's going on in the US and tariffs. So let's have a look at why. So this is the market's view of future interest rates. And you can see it's the instantaneous forward 1 year forward rate. And you can see that it's come down. It hasn't spiked up as we go forward. And I think the reason for that is the market's decided this is pretty bad for growth, but it's not going to be that bad for inflation. And so I think the Fed's credibility is very important to what's happening in financial markets. And if we move forward, then we can see that the break-even inflation rate is actually lower now than it was at the beginning of the year. And so the market's really, so this is the rate that equalizes the return of an inflation-linked treasury with a conventional treasury for a 5 years, 5-year bond. And what we see is that it has picked up somewhat, but it's not exceptionally high. What it really tells us is the market thinks there's going to be a short-term hit to inflation, but that's not going to last because the Fed's credible. And in fact, I think Mr. Powell must be grateful to Donald Trump for criticizing him and for threatening him to sack him, because Powell's come out and said, well, I'm not going to cut interest rates, even though I've got a huge political pressure on me. That is credibility building. That is definitely credibility building. What the market wouldn't want to see is a Fed chair who thought something very different. So let's move on to the next one. So this is SOFR, the Secured Overnight Funding Rate. So this is what we look at in the US instead of LIBOR. And it looks at the difference between the secured overnight funding rate and Fed funds, which is the Fed's target. Normally, it trades at a small discount to Fed funds. And the reason is it's a secured funding rate. What you see from 24 was that it moved to a positive which is a sign of incipient financial stress in the market, because you shouldn't have to pay more to borrow with secured funding than you do with unsecured, which is what Fed funds is. And in March, we heard Powell talk about potential financial stress in money markets. And I think he's referring to the SOFR minus the Fed funds. What you can see now is we got very negative gap between SOFR and Fed funds. And that's really indicating there's plenty of liquidity. Now, this chart is one that the Fed looks at a lot. It looks at basically, if it's zero, the Fed's happy because it tells us there's plentiful liquidity in the Fed funds market and that shocks to the quantity of Fed funds traded have zero effect or near zero effect on the Fed funds rate. And so it's close to zero, and the New York Fed's view is liquidity is abundant, which ties in with the previous chart. So let's move forward and look at high yield spread. So this is high yield spreads in Europe and the US. Europe follows the US very much. The US is the fulcrum of the global financial system, as Professor Ray has taught us. And what we saw was a huge spike in high yield spreads compared with safer spreads, and that has now come off. So people were very worried. There's going to be a big inflation hit. Interest rates are going to have to go up. Growth's going to be hit very hard, and the guys who are going to really suffer are going to be those with large indebtedness in relation to their cash inflows. That worry seems to have gone away. So the market's decided, okay, we're going to have slower growth, but it's not going to be a massive hit. So if we go to the next one, now this is the exchange rate, and the exchange rate is something where we have seen a lasting impact. And I think one of the reasons for that is that the real exchange rate has been at an extreme level. We saw a similar level at the end of 2022, but before that, the only time we saw something like this was in 1985, when we had the Plaza Agreement to bring the dollar down. The dynamics around Plaza now are very different, because Plaza saw a very sharp upward increase in the dollar. This has been much more gradual. It's been much more driven by fundamentals, by which I mean relative US growth, relative US interest rates, and terms of trade shock that has favored the oil producing US relative to the oil consumers of Japan and Europe. And so I think that the dollar was kind of vulnerable at those levels. And we see that if we look at this, the yen and the dollar, at yen and the dollar yen rate and dollar and euro dollar. So what we see, the blue line is dollar yen, and we see it come off from a peak of around 160 to close to 140. So a very big move. Remember that the Bank of Japan was resisting going through 160, was worried about that. But at the same time, you can see it's not a yen move per se, because euro dollar moved, and remember euro dollar is the opposite way around to dollar yen. Euro dollar moved at the same time as dollar yen, so this was really a dollar move, and what we saw was another big adjustment there. And but for both of them, that seems to have petered out. So we've had an adjustment, 8% or so, but that seems to have petered out. But it is a level adjustment, and I think this tells you that the market is worried about growth, relative growth. There's also a credibility story about the US, and is the US going to lose its reserve status, which I don't think is likely. In fact, foreign exchange reserves of central banks, if you look at IMF numbers, been pretty flat around 6.6 trillion since 2018. So people have not been adding to their dollar reserves. I don't think they're going to reduce them very quickly, because There's no real alternative. But there's definitely been a shift in the exchange rate that's important. And the reason it's happened in the exchange rate rather than in domestic markets is domestic markets are really tied down by the Fed, if you think about it. That the central bank policy rate really ties down, is the gravitational center of the universe for everything else that goes on. There's not a similar gravitational effect for the exchange rate. Okay, so if we go to the next one, let's give the conclusions. I think markets have calmed down a lot. Stress in money markets has gone, and how yields have declined. Bonds don't believe there'll be a persistent inflation shock. The Fed is credible, and I think that's really important because I suspect at some stage Trump will get more frustrated with Powell. He probably won't sack him, but he might announce a successor. And my money would be on Kevin Walsh, be, long before Powell's term's up in May next year. And that would undermine Powell. And I think that would undermine maybe some of the market beliefs. FX markets have adjusted significantly, but the dollar was overvalued. I think the story is really the market sees what's happening as a hit to growth, probably a temporary hit to the growth rate, a permanent hit to the GDP level. Wharton said probably a 6% hit longer term to the level of GDP. Probably a bit of an overestimate. But so a hit to the level of GDP justifies a lower dollar. The market thinks that inflation's temporary and therefore the Fed interest rate cuts will come. They've just been pushed back in time a little bit. And so I think that's the market view. It's no big deal. And I think part of the reason they think that is because they think Trump's backing off. He came in heavy, he came in with massive tariffs, and China faced him down and he's backing off. And so the market view is it's all going to be okay. I think that's vulnerable to two things. One is Trump's unpredictability, and two is events. If we see some financial stress coming out, we're going to see much weaker growth and maybe a more turbulent time for markets. Thank you.
Thank you very much, Paul. Interesting to see that the markets think Trump is backing down. Fergus is now going to tell us about what we think the tariffs, what effect the tariffs might have had if they'd been remained in full, what we think they will have if Trump continues to back down. So, Fergus, over to you.
Thank you, Stephen, and thank you, Paul, for your insightful presentation. I learned a lot. So to just dive in straight away to the key messages. So for me, the first point is that tariffs particularly hit the United States, China, Canada, and Mexico. Given that the US is going to feel obviously tariffs very directly in that there'll be higher inflation and low growth there. But Canada and Mexico, as they're so adjacent to the US and their trade share with the US is such a significant component of their economy, will also be feeling that. And of course, China, with such a high tariff rate, will also be particularly hit. The second key message is that the impact on the UK in our central forecast is actually quite limited. And really, for me, the key takeaway for tariffs is that they impose a wide range of risks that the UK perhaps isn't in the best position to be insulated against. And the final two key messages for me are really that there are downward tariff-related risks to growth globally, reflecting mainly uncertainty and reduced trade activity. And there are upward tariff-related risks to global inflation, which reflect supply chain disruption and retaliation that can exacerbate this. So for some quick background, as I strongly suspect you are aware, on the 2nd of April, Trump announced what he called reciprocal tariffs, ranging from about 10% to 54% on all countries. And obviously since then, that range has got even larger. So this caused significant disruptions in financial markets, with stock markets around the world recording substantial losses. and the long-term US bond yields rising significantly. In particular, as you can see on the right-hand graph, the VIX, which is widely seen as the fear index by global investors, rose to the third highest daily figure after the COVID-19 pandemic and the global financial crisis. So partly because of this, Trump announced a 90-day pause on some of his tariffs on the 9th of April. And as of the 9th of April, as you can see in the left-hand chart there, these tariffs increased the average effective tariff rate to around 20%, which is the highest level in over a century. Just to give kind of a feel as to the gravity of tariffs and quite how impactful and historically significant they are. So going on to global GDP growth, we think that growth in the United States will be worse off over the next 3 years due to tariffs. Tariffs will be inflationary for the US, which will likely depress supply capacity and aggregate demand, while additionally warranting a more restrictive stance on monetary policy, which we've heard from Paul seems to be a credible mechanism. And direct uncertainty effects will also depress growth in the United States. Aside from that, we expect Canada and Mexico to be the biggest losers in terms of GDP growth over the next 3 years due to tariffs. This is because large shares of the economic activity in these countries are tied to trade with the US, leaving them particularly exposed to these protectionist policies. We think since China faces very high tariffs, which is still true, even in spite of the current new 90-day pause between China and the US, we also expect China's GDP growth to suffer. The picture is slightly different for the euro area and the UK. While lower global demand will depress growth in each of these economies, we think that lower oil prices and exchange rate movements for the time being favor a more limited impact on growth for the euro area and the UK. So moving on to global inflation, tariffs we think will pretty straightforwardly increase the price of goods imported by the United States for businesses and consumers. You can see in that left-hand graph that cumulative inflation is much higher in a world where the US implement tariffs as they have done. Interestingly, the picture is a bit more mixed across the world. Reduced global demand, exchange rate movements and lower oil prices are all set to weigh on inflation. However, that's not to say that there are not significant upside risks from channels such as supply chain disruption, trade diversion, and the very real possibility of widespread retaliation. Each of these things could certainly have upward effects on global inflation. So moving on to global risks, we see the risks to growth as skewed to the downside with respect to tariffs. We think that elevated uncertainty could have a more severe effect on growth than captured by our central forecast. And additionally, given the risks of retaliation and supply chain disruption, we think that there is scope for larger than forecast contractions in trade activity in the next few years. We think that the risks to inflation are skewed to the upside, and this is because there's potential for significant supply chain disruption. And again, the threat of retaliation, potentially widespread retaliation, would only exacerbate this further. So I'm now just going to move on to the UK outlook. And I think it's worth saying up front that tariffs are actually not the main story for the central UK forecast. You can read our UK economic outlook for a deeper and more detailed picture on that. But I do think the biggest impact of tariffs for the UK is just the sheer degree of risk that they impose for our outlook. So we think that there will be a direct uncertainty effect from tariffs that will be important. The UK has already been plagued by uncertainty coming through speculation over things like the spring statement, but also looming rises in employer national insurance contributions and hikes in the national living wage. Tariffs will serve to exacerbate these uncertainties, which we think will depress spending and investment this year. We have also downwardly revised our forecast for export volumes this year, again reflecting the effect of tariffs on trade activity and growth in key trade partners such as the United States and euro area. There are upside and downside risks. Oh, sorry, just quickly go back to the previous slide. There are upside and downside risks to the growth outlook for tariffs. For one, on the upside for growth, trade diversion and oil prices could increase supply side capacity by making things like raw materials and intermediate goods cheaper. But also supply chain disruption and the threat of retaliation potentially, not necessarily from the UK, which I think we would potentially be ill-advised to do, but more broadly for other trade partners, the threat of retaliation definitely exacerbates the inflationary risk of supply chain disruption. So moving on to the UK inflation outlook in light of tariffs, we see inflation risk on tariffs as also broadly balanced. We can see potential for disinflationary effects coming from trade diversion, lower oil prices, and we can forecast demand. I think it's worth saying at this point actually that trade diversion, if this is a one-off kind of diversion in trade, this is likely to just show up pretty temporarily. And so you might see a more muted reaction in the monetary policy response if that's the case. But aside from that, we can also see inflationary effects materializing through supply chain disruptions again as a main threat here. The UK is a relatively small open economy and is therefore vulnerable to supply chain disruptions. Tariffs could increase the price of intermediate and final goods whose supply chains run through the United States, thereby adding upward pressure on UK inflation. So as a aside as well, I've singled out exchange rates as a particularly important channel, because following when tariffs were announced, the pound sterling effective exchange rate appreciated while the US dollar depreciated. This represents a change in the risk sentiment toward the United States among investors, as the US dollar is typically regarded as a safe asset in uncertain times, which would anticipate appreciation in the current climate. With an abundance of risk over supply chain disruptions, scope for further trade policy volatility, and uncertainty over economic prospects across the world, movements in exchange rates, particularly the sterling exchange rate, could be very consequential for the UK growth and inflation outlook. Importantly, the exchange rate movements affect not only the price of goods, which is kind of what the tariffs are predominantly focused on, although there's some talk obviously of tariffs on UK produced films, whatever that means, but also services. If we see exchange rate movements, this could be a much broader effect on the role of tariffs for our economic outlook. And importantly, these exchange rate movements are also not confined to the US dollar. Movements in the euro are also important for the UK outlook going forward. So I thought I'd finish with a brief discussion of the implications of tariffs for fiscal and monetary policy. So tariffs have weakened confidence further in the UK, but there's the key risk here is that there's limited scope for fiscal or monetary policy to really counteract some of the potentially significant risks that tariffs pose. So the UK is not on track to meet its fiscal rules. With fiscal credibility at risk, the government might want to consolidate finances in the autumn budget. Otherwise, we're likely to see financial market agitation. And also, should downside growth risk materialize, this basically just means that there's a limited scope for further fiscal support, which would put the government in a rather compromised position. Moving on to monetary policy, there's still substantial, there is still very reasonable arguments for saying that there is inflationary pressure in the UK. The bank maintains a gradual and careful approach to rate cuts. And with trade fragmentation, elevated wage growth over the forecast, scope for further rate cuts we think is limited. A particularly difficult position would be one of supply chain disruption or sterling depreciation, where inflation and growth point in opposite directions. This would make it particularly hard for monetary or fiscal policy to maneuver out of this situation. So as a final thought on tariffs, we think that tariffs will weigh on global growth and push up on inflation. Insofar as the UK, we think there'll be a limited impact, but there are considerable risks. And I think an important insight here is that should downside risks to tariffs materialize, there is limited scope for further fiscal loosening without agitating financial markets.
Great, thank you very much, Fergus. So the bottom line, tariffs maybe not so important for the UK, other than the uncertainty that the going back and forth has created. But of course, there are particular industries within the UK that do export to the US. So I'm now going to call on Adrian to tell us about how the tariffs may have some regional impact within the UK.
Thank you very much, Stephen, and thank you, Paul and Fergus. And what I'm going to say really follows on very much from what both Paul and Fergus have already outlined, which is the impact is more limited. And in the case of the UK, it's limited to a particular number of regions and indeed sectors within regions. So what we know is that when Liberation Day was proclaimed on the 2nd of April, there was a 10% US tariffs as a baseline, and then 25% on certain goods. Now that seems to have been reversed by the recent UK-US trade deal that was announced last week. Though, of course, as always, you know, the devil, as always, in the detail. And we need to really see how this will be translated into particular arrangements. But what we can say is that that is good news for UK regions and sectors, because, of course, there are a number of goods now that will not be affected, notably, you know, the car industry and vehicle parts, as well as aerospace, and also steel and iron goods that are also exported to the US, as well as non-ferrous metal goods. So let me show you, first of all, what this means in terms of regional output as measured by gross value added, or GVA. As you can see from this chart, really overall, there isn't a big impact at all of the 10% tariff baseline, because, you know, the proportion of exports to the US in terms of regional are really rather small. So they tend to be on average somewhere between 1.5 and 2.5% of output. That's all that really relies on exports to the US. Now, within that, there are just two slight exceptions. One is the Midlands, and the other is Wales. That is because both in the Midlands and in Wales, there's a certain concentration of sectors and businesses that are more reliant on exports to the US, including manufacturing, in the sort of car industry and aerospace, but also machinery, transport equipment, for example, some of the Airbus production in Wales. But even here in the Midlands and in Wales, we're talking about somewhere between 4 and 4.5% of regional GVA that depends, or that is exposed, if you like, or affected by US tariffs. So again, a very, very small part, but it's nevertheless important for sectors in those regions. And if we then move on, we can see that had the 25% tariff stayed in place for vehicles and vehicle parts, again, that would have had an impact in areas such as the Midlands, because there's a sort of concentration of, you know, of car production. You know, Aston Martin, Jaguar, Land Rover, and Rolls-Royce are all located in the West Midlands, and that would have affected those businesses in those sectors in the West Midlands. But overall, as you can see from this chart, there's a very low reliance on exports to the US, whether it's 25% or indeed 10%. So that is, on the whole, good news. Again, something similar is true for steel and iron. Generally, very low reliance on exports to the US, which is good news. We're not so exposed, and there isn't going to be a big impact, bar perhaps certain businesses in specific sectors in Wales, but also in Yorkshire and the Humber, where that is more in the range of sort of somewhere between 8 and 10%. It was higher, interestingly, in the past, in 2022, as you can see by the red bar. The grey bar is 2023. That's the most recent data we have. And you can see that that exposure, that reliance, is actually not quite as great as it was. So again, on the whole, not much of an impact. If we then move on to aluminium, same story, with the exception of two areas. One is the northeast, and the other one is the east of England, where there is something, you know, in the range of 20 to 22, 23% of non-ferrous metals, so mostly aluminium goods exported to the US as a proportion of regional GVA. It is again rather limited, and certainly in other parts of the country not significant at all. All of which means really that we can say a few things in conclusion of this analysis. First is that there is no great reliance on the US market. In terms of economic output for regions, it's, as I said, somewhere in the range of 1.5 to 2.5%. However, we should notice the risk of hidden indirect exposure in terms of supply chains and dependent sectors. So there's always these effects that could happen depending on what else is decided in terms of tariffs going forward. So that's one risk to bear in mind. Clearly, the West Midlands and Wales are probably the two regions where there's the greatest exposure, whether it's 10% or 25%. Again, this is really concentrated in certain sectors such as car, aerospace, steel, and also non-ferrous metals. So those regions, therefore, conversely benefit the most from the new UK-US trade deal that was announced last week. Again, steel and aluminium, it's a low share of regional output, and so there's some localized benefits of this new deal. However, what we should be factoring in, and this is something that both Paul and Fergus have also mentioned, which is, this is really not the main thing driving the UK economy, or indeed the US economy, or the global economy. There are other challenges, but this uncertainty and risk reinforces it. So in the UK in particular, there are pressures on business, on investment, in terms of cost pressures arising from increases in the national minimum wage, increases in the employer rate of national insurance contribution, potentially new regulation, and all of the tariff uncertainty certainly compounds those challenges. So rather than seeing these as completely separate, it's only domestic or only international, the risk is where, all of this is tied together. So the question for policymakers, therefore, how can they absorb shocks? How can they decrease risk so that businesses can invest and indeed export to the US going forward? Thank you very much.
Thank you very much, Adrian. Thank you very much, all of our speakers, for some excellent presentations. I learned a lot as well, and I guess that's good. We have a couple of questions already. Adrian sort of teed them up in a way by talking about our ability to withstand shocks. And of course, the ability of a government to withstand shocks depends on its ability to carry out fiscal policy. So Stephen Gregson, I believe, has a question on this. So Stephen, if you'd like to unmute yourself, or we'll try and unmute you, and then you can ask your question.
Thanks. Yeah, given how much the world has changed over recent months and continues to change, isn't there more strength to the arguments that UK government should revisit its self-imposed fiscal rules and that policy not be hidebound by these artificial rules?
I think the quick answer is yes, but maybe I'll ask Fergus to expand a little bit on that.
Yeah, so the economic kind of rationale is there. I think there are a couple parts to this argument though. So I'll start with maybe one side, which is markets aren't stupid, right? They can see that punishing violations of fiscal rules when it's actually necessary to infringe them for one reason or another can be permitted. So in my mind, that suggests that there could be some appetite in markets for creating exceptions for defense spending, for example, rather than general fiscal headroom. You've seen recent reforms in Germany, for example, able to generate some more fiscal headroom and change the rules around that. However, importantly, and this is associated with Germany, it helps if a government has a track record on fiscal rules. Without this track record, the government may nevertheless see rising risk premia, even though on paper there is more fiscal headroom. I think Paul Mortimer-Lee actually astutely pointed out after the autumn budget that generating more fiscal headroom on paper does not change the fundamental economy you're dealing with. Ultimately, the case for changing the fiscal rules, and there is one, is that the government needs to convince markets that changing the fiscal rules will make the economy fundamentally more sustainable and produce more growth than otherwise would have happened. So it's really about that communication, I feel.
Thank you, Fergus. I've got somebody called Chris who has a follow-up question to this. Chris, if you'd like to unmute yourself and ask your question.
Thank you, and thank you all for the presentation. It's tangential to the previous question, but but it's what are the downside implications of the different options open to the Chancellor re the forecasts on breaching the self-imposed fiscal rules?
Thank you for your question. Paul, do you want to have a crack at that one? What's the downside here?
Sorry. Yeah. I don't know. It depends what you think the fiscal rules are there for. My view is they're there to keep the backbenchers under control and say, I can't do this because of the fiscal rules. Does anybody in the market really believe that the fiscal rules are going to last this Parliament? I don't think so. I mean, they're an arbitrary constraint. One of the problems, I think, is that they're not really tied in to the needs of the economy. So, the rule about balancing the current budget is a nonsense. One of the UK's great problems is a lack of investment, giving us low productivity, and that's partly due to low private sector savings. If private sector savings are too low, it's up to the government to save more to offset that, to make sure there are adequate savings in the overall economy. They don't do that. So the fiscal rules are so arbitrary. I think there is a real danger that if the fiscal rules are fudged or if they're broken, the market will decide, I'm sorry, but the UK isn't sustainable. And I think that's the biggest constraint and the biggest risk. It's got to look credible. Giving yourself a tiny bit of headroom is really sailing too close to the wind, because you're almost certainly setting yourself up for failure, because it's very rare that you do better than your targets. You almost always do worse. I think if we had a credible path, even if it wasn't bringing debt down at the end of the Parliament. I mean, to be honest, the debt objective is a nonsense. It's so far away that nobody believes it. And I guess the problem with the current set of fiscal rules, it says the government's going to take some pain, but it's really going to be in the far future. We're not really serious about getting the debt under control. And I think, as the presentation said before, we've got very little headroom to deal with a downturn. And that's also true with the US. I think the US, with the Trump budget, is probably going to be worse. The next downturn in the US, we could see a deficit of 10% of GDP. And if we see that, and there's this undermining of the credibility of the US, then the term premium, that's the difference between expected future spot interest rates and what the Treasury has to pay to borrow at 10 years. The term premium is going to blow out. And if the US term premium blows out, the UK term premium will blow out. And if the UK is not looking credible, then it may blow out by more than the US. So I think we're in a really risky position where the gilt market could turn very nasty indeed. And that's partly because there's such a big chunk of gilts now that are owned by hedge funds and other speculative accounts. Gone are the days when you could rely on defined benefit schemes just to buy up the gilts, because they've gone away. And so we've got a very volatile holding from hedge funds. And that's why it's very, very risky if the Chancellor doesn't stick to the fiscal rules. But if the fiscal rules are not credible, then she won't be able to stick to them. She won't be able to stick to them. I think the market would welcome a bit of honesty, say, this is the path. This is what we're going to do. And it looks credible, because at the moment, it looks as though we're in a repeated cycle. It's Groundhog Day, where the next budget review comes up with, oh, we're not going to meet our target. We're going to have to do something else. And I think it's undoubtedly true. There's going to have to be a big tax increase coming forward. I mean, And there the risk is that that's going to damage growth, because we've seen that growth already doesn't look good. So, if you don't stick to the fiscal rules, the gilt market is going to punish you. If you do, you're going to hurt growth. I'm not sure I'd want Reeves's job.
No, I certainly wouldn't. That's for sure. Okay, we're going to move away from fiscal rules to a question that John Fitzgerald would like to say. So, John, if you want to unmute yourself and ask your question.
Could an EU-UK agreement next week make a difference to the outlook for the UK?
UK-EU agreement, Fergus. Actually, Adrian hasn't spoken. Maybe we'll give this one to Adrian.
Well, thank you. And obviously, I hugely welcome Fergus's thoughts as well. So let me just share a few brief thoughts. I think, John, it's a really good question. Of course, as always, much will depend on what is in that deal. We've seen various things trailed already in the papers about it. I think the security and defense pact that's on the table will not have a massive economic impact, because I think the announcements we've already had from the Chancellor about defense spending are well known, and we've incorporated them. There's an increase in defense spending from 2.3% of GDP to 2.5%. That will have no aggregate impact, but it will have some regional and sectoral impact, because the defense industry and the production of various elements of that tends to be outside of London and the southeast. So there will be some local effects which are going to help at the margin in terms of regional growth, but they are going to be small, because we're not talking very large amounts. The other elements of the EU UK trade deal, again, don't seem to be having massive economic effects in the aggregate. We're looking at certain things in terms of food imports and exports, veterinary arrangements. I think there will be some removal of certain barriers to trade, so that's certainly welcome, but no impact that would fundamentally change our growth outlook. But if it is about business confidence and then also business investment, that of course over time will have some positive effect. But this will take a bit of time. This isn't going to be happening in the next quarter or next 6 months or so. And finally, the mobility scheme, which doesn't seem to be fully negotiated and agreed yet. Again, long-term implications, but certainly no short-term boost to growth. But Fergus probably has some more thoughts.
Thank you very much, Adrian. Fergus.
I agree with everything Adrian said. I think I would personally highlight maybe one of the endpoints there on business investment, which is people are looking at the UK quite speculatively at the moment, with rising protectionism, a change in risk sentiment towards the US. Whether or not that's here to stay is a separate question. But certainly at the moment, I can see of no better time with respect to kind of bang for your buck in getting closer to the EU. And I think that could serve as a very strong signal for business investment, and that will obviously carry on down the line and potentially, help with productivity and things like that. So it won't shift the dial for the UK, but it goes in the right direction for sure.
Thank you very much, Fergus. We're currently out of questions, which is a bad position to be in, because that means that the panel are going to have to answer my questions, which I'm sure they really are going to hate. So please, 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 if you have a question, and there's lots of stuff that's been discussed today, could you please put it in the chat and we'll call on you. While we're waiting for people to add their questions, though, I'm intrigued by Paul's presentation and the idea of Donald Trump rolling back on the tariffs and basically moving backwards. The question, I guess, Paul, is what will he go back to? Will it be 10% across the world, or will it be something closer to where we started prior to Liberation Day?
I think it's difficult for him to go back to exactly where he started. So it'll be 10%, and then the MAGAs will come out and say, out of the deal, this was brilliant bit of negotiating and all the rest of it. I mean, personally, I think that's just wrong. I think really, when we talked about, I think Trump's right to worry about deindustrialization. He's right to impose tariffs on some people. So, for example, Taiwan's exchange rate is half or double, depending which way you want to look at down the periscope, what it should be according to purchasing power parity. So there are a lot of people who've been abusing the US, but that's not everybody. I think tariffs, the threat of tariffs could have been used as they were before the 85 Plaza Agreement to get some more understanding about the currency and to get the currency down. Tariffs are a very crude weapon, in my view. I think he thinks that tariffs are going to give him revenue, and that's one of the reasons he's not going to back off completely, because how's he going to fund the tax cuts for the rich that are coming in his budget? And tariffs, which will basically hurt the poor in America more than anybody else, are going to be the solution. So we're going to see a redistribution of income from the poor to the rich. And he can't back off tariffs entirely without giving up his tax cut hopes, I think. But, you know, the kind of crazy tariffs with China, it will back off some way, but not all the way, because the US is in geopolitical conflict with China. And so part of the objective is to hurt China and hurt China's growth. I think China's retaliation on rare earths was extremely powerful in persuading him maybe to back off to the extent he has.
Thank you, Paul. I mean, there's a kind of a political question in my head, really, that one of the effects of these tariffs is surely going to send the world into, well, two things. One, it's going to send the world into different geopolitical blocks, and the second is it's going to send countries away from the US. So I don't know, Adrian, if you have any thoughts on will this maybe be the thing that gets the UK much closer to Europe?
Well, it's really a fascinating question, Stephen, because one does wonder whether this negotiating tool that Paul has already highlighted as being really crude, ends up backfiring, because if part of the strategy is for certain countries to really choose between the US and other trading partners or blocks, then it may well achieve the opposite. Now, I think in the case of the UK, it's going to be very, very hard to see a situation where the UK sort of decides that it is in some sense going to try and roll back from trade with the US, because it just cannot afford it. The dependency, and the interlinkage with the US is really, in certain areas, especially services, really quite strong. So I don't think we're going to see any sort of decoupling there. But absolutely, the more this is volatile and unpredictable, and the more the US looks like a source of uncertainty and threat rather than a source of stability, then of course the incentives to do a closer trade deal with the EU will only go up. So I think that's one implication. The other implication will be interesting for European countries. Are they going to be in a situation where, in some sense, whether they're individual trading arrangements or really through the EU, they're going to have to choose between the US and China, and that I think will be a huge source of tension. Not quite clear yet in what areas, but you could imagine in the area of AI that there will be a lot of pressure to sort of say, are you with us or are you with China? And that, I think, geopolitically will be a massively important question going forward.
Yeah, it'd be very, very interesting to see how we respond to that. The other interesting thing, I guess, about tariffs is everybody knew that they were going to be announced. So everybody started exporting like crazy in the first quarter of this year, which meant that UK GDP actually grew quite substantially. Fergus, I'm wondering if what the story I've just told is actually even remotely true, and whether or not it is. Where do you think UK GDP will be going in light of what we've seen in the first quarter of this year and all the things that happened in April, and of course the tariffs?
Yeah, so the first quarter of this year was pretty exceptional. It was a lot higher than people expected. And unfortunately, I'm not sure if it's a sign of things to come. I think that there could plausibly have been some pre-ordering and stuff like that, kind of people getting their manufacturing orders in early, stock up in inventories. But again, throughout the first kind of quarter of this year, it was very much speculative. So I don't have anything to hand as a breakdown of the contribution, but I think some of the strength in the first quarter will at least be due to some kind of underlying strength that maybe people overlooked. However, as of April, I am not confident that this underlying momentum, if it was there or not, is likely to survive. I think a lot of the growth for the remainder of the year will be stimulated from whatever private consumption can happen and government spending. I think the PMIs for April were pretty clear in that there is a clear downturn in economic activity in April, which is kind of the latest data we have there. And I really think that the government would do well, and more broadly, international policy would do well to get any kind of certainty they can on the table. I think right now, the thing that can really save the economy, given the UK economy specifically, given how stretched we are precariously with their public finances, and that inflation still looks pretty persistent, is restoring those sentiments one way or another.
Thank you. I'm still waiting for questions from the audience. I'm sure people have got questions, so just please put something into the chat. We just talked a little bit about the UK. Let's come back to the US, and Paul, you're in the US at the moment. Quarter 1 GDP fell. Is this all to do with uncertainty, or where do we see the US going?
Yeah, well, we saw weak GDP in the first quarter. Everybody said it was imports, but imports clearly did come in, but they went into inventories. So there was softness in final demand. We've seen demand for mortgages come off somewhat. I've been trying to sell my house, and the market's frozen because everybody's uncertain. And the same is true of business. People don't know what's happening. Okay, we've got a moratorium on tariffs for 90 days. Well, we'll see where we are after 90 days, but people are just postponing investment because they're not sure. And that uncertainty, which has been mentioned several times, I think is important. I think consumers' inflation expectations, we looked at markets' inflation expectations, and they're well contained. Consumers are off the charts if you look at some of the surveys. And so people are expecting very bad times coming, and so are cutting back on discretionary spending. What hasn't happened yet is a weakening in the labour market. And I think, the monthly payrolls numbers, as always, the key in the US. And that will be important going forward, because if we see those starting to crack, then I think expectations will quickly turn to be much more negative than they have been. And I think that's crucial. The other thing is inflation, where we haven't really seen any impact of tariffs. We've seen headline inflation come down recently. Some of that was oil. And clearly some of the oil coming off is partly OPEC and the quotas, but it's also worries about future demand. So I think the worries about demand are very much there. They haven't yet been realized. I think we're going to go close to a recession in the US, to be honest. And I am expecting weaker numbers to come, including in the payrolls market. And that could be crucial in changing expectations, and changing expectations about the Fed, to be honest. Because I think what's been holding the Fed back is worries about inflation and the fact that the labour market has held up. If the labour market softens, the Fed's tune will change quite quickly, I think.
Okay, thank you, Paul. Well, you heard it here first. There is a possibility of a US recession this year. So we will keep watching that. We will, of course, keep watching to see what happens to tariffs. 90 days will be just in time for us to prepare our next forecast, our UK and global economic outlooks for the summer, which will be coming out right at the beginning of August. Between now and then, we have a number of other things going on at NISA. Please have a look at our website. And I'd like to just point out that events like this, we love putting them on. This is our charitable purpose. It is to to help educate and inform all of you, our wonderful audience, about what's going on in the global and UK economies. But we can only do that with your support. We have corporate members, we have individual members. If you would like to continue to see these kind of webinars, please consider individual membership. There are a number of other advantages that comes with them, and all the details can be found on our website. In the meantime, with no further questions from anybody in the audience, I'm going to wrap up today's webinar. I'm going to very much thank again our panelists, Paul Mortimer-Lee, Adrian Pabst, and Fergus Jimenez England, for excellent presentations. Somebody asked if a recording of this event will be available, and the answer is yes, it will. The recording of this event will be available on our website, as indeed are recordings of almost all the events that we hold. So please go to our website, have a look at all the wonderful things that we do and that are going on, and then have a look at the individual memberships. On that note, I'd like to say thank you very much for attending this event, and I look forward to the next one. Bye-bye.